Hi, and welcome to another financial analysis video with myself, Moeed Amin, and Ted Wayman. So today we're going to be looking at Align technology. Now, quick note on the purpose of these videos. This is an education platform, and we're here to help you improve your business acumen by learning the language of business, which is finance. And we do that by analyzing financial statements of famous, well-known companies so that you can see how we do it and you can replicate and practice that for yourself. So looking at Align technology today, quick note about Align technology just for context. So they manufacture digital or 3D digital scanners, and they also have products, the most well-known being Invisalign, for the orthodontics industry. Think of them as a medical devices company that's specific to the orthodontics industry. Now, an important thing to note about this company is they, in May, I think it was May 2021, they announced a kind of program for stock repurchase of up to $1 billion. They recently announced an accelerated purchase of common stocks to the tune of $200 million. So as of September of 2022, they've purchased about 550 millions worth of that. And after this 200, they have another 250 million to go. So important to note, because that's obviously going to have an impact on the share price. And we're going to talk about the share price later on, so stick around for that. This company was a request from one of our viewers. And so 98% of the companies that we analyze here are requests from you, and stick around because we will show you, if you're interested in the company, how you can do that as well. And we'll describe that towards the end of the video. So Alfie Saunders, thank you for your request. Here is your video. I'm going to talk about the share price very quickly and then hand over to Ted to walk you through how you can analyze the financial statements of a company like this. So if you invested when they floated in 2001, you'd be sitting on a handsome increase of 1,250, which is not too bad. If you invested 5 years ago, you'd be sitting on a decrease of about 28%. And if you invested a year ago, you'd be sitting on a decrease of about 70%. So certainly there have been some ups and downs in the last 5 years, and we're going to look into that in more detail. So without further ado, let's transfer over to Ted, and we'll walk you through how you can analyze the financial statements of a company like Align Technology.
Thank you very much, Moeed. Good to see you again, and welcome back to all our subscribers. Welcome. If you are not a subscriber, please do subscribe. Don't forget to like, share, and subscribe to the channel. So let's go and have a look at the financial statements, if I can find them, and analyze the performance of this business. Here we are. We're looking at the financial statements. We are dealing in thousands, you'll notice. So we are so we're in dollars, in thousands of dollars. So here we can see the sales is basically 4,000 million, which is about 4 billion. So $4 billion of sales for this company, and that is up on the previous year of about $2.5 billion, and that's an increase of about 60%. So this is a massive increase, pretty flat line from 2019 to 2020, but it is now a big acceleration in terms of its revenues. Cost of sales, about $1 billion, leaving them with a $3 billion profit, and that is a massive 74, nearly 75% in terms of their profit, their gross profit margin. So that is a massive 74%. So very profitable in terms of the sales and the cost of sales. We then got the cost of running the business, about 1.7, nearly 2 billion there, leaving them with about a total of 2 billion, leaving them with about $1 billion in profit. So 4 billion of sales, 1 billion cost of sales, 2 billion to run the business, leaves them with $1 billion in profit, they get a tax refund. I'm not sure exactly what's going on there, but they do get a sorry, that's other income. Down the bottom, they get this tax refund. That was last year. They got a massive tax refund. I'm not sure why that is, but that was a big driver of their big profit. This year, they're paying a little bit of tax. And the bottom line is about $772 million in profit. So 772, that's about a 20% net margin. Okay, so 20% is pretty good, and a pretty good profit margin for this business. So looking pretty good here from a profit and loss account point of view. No gremlins jumping out there. Little bit of R&D, but not excessive. So they are investing in the future. They are kind of, they're developing. They recognize that, this is cutting edge technology, and they need to stay at that cutting edge technology. And then the rest is, this will be rent, rate, light, heat, marketing team, sales team, finance team, HR, rent, the technology, facilities management, and all those other costs that you have in terms of running a business. Let's go look at the balance sheet. So here is the balance sheet. We'll look at the assets first of all. These are the current assets, which are things which are cash or going to become cash soon, versus the things that we need to run the business. Biggest numbers they've got. So they've got this lot of property, plant and equipment. We should really read that together with this kind of right of use assets. Interesting, they've got deferred tax asset. I'm guessing, I'm not a tax accountant, but I'm guessing that is related to their investment and their R&D. So that is effectively a tax rebate that they're going to get, but not for a while. They've got a lot of cash. So when we look at the cash, we should really be using these two numbers together. This marketable securities, this is just a place where companies, they sort of stuff a bit of extra cash, and actually you'll notice they've got a bit of a sort of extra long-term marketable securities, which we should also really just classify as cash as well. Then they've got the accounts receivable. These are the customers who owe them the money, and then the inventory, which they are due to sell. So and actually, just while we look at this page, we can see the accounts payable here down the bottom. So the accounts payable is paid to their suppliers. The accounts receivable is from their customers. The inventory is sitting in the warehouse. We can actually plug those through a relatively kind of straightforward calculation to see that it looks to me, based on these numbers, that they spend, it takes about 66 days to sell their inventory, another 72 days to collect the money owing to them, looks quite high to me, and 50 days to pay their suppliers. And that gives them a working capital requirement of about 88 days. And that means that they need about 700 million working capital. They've got about 600 million, so it looks to me like they're reasonably capitalized, that liquidity is not an issue for these guys. There's a couple of other reasons why we think that liquidity is not an issue. So we can compare the current assets to the current liabilities. There it is. They've got a lot of cash. As we said, some of that cash is sitting on the non-current assets. The current assets easily exceeds the current liabilities, just so we are familiar that is a ratio of 1.3. So for every $1 they owe and have to pay soon, they have $1.30 either as cash or coming in as cash soon. And also look at this number here. Okay, so this is a big influence. So this is our deferred revenue. So this is money that their clients pay to them in advance of them actually providing the good or service. So actually, what you're going to find is that they've got very, very, very strong cash flows indeed as a result of that particular money. Looking elsewhere on the liabilities, no debt. There's just no debt at all on this company, and therefore they're generating lots of cash. They can pay their bills. The suppliers is relatively low. Things look pretty good as far as I can make out. And then on the equity side, so if we take the assets, total assets, you deduct the liabilities. So assets of about 6 billion, liabilities 2.3 billion. That leaves you with about 3.7 billion of equity, and that is really driven through this retained earnings. So these guys, they've been making profits. Those profits have been reinvested back into the business, and that has been funding the business. It's an equity funded business. If we look at the movement in earnings, that particular number, so here we're looking at the kind of, they start with 2.2 billion, they finish with 2.6 billion in terms of retained earnings. We can see those numbers here. There's the 2.5, there's the 2.6 billion, there's the profit that comes from the profit and loss account that we were just looking at, and you'll notice here is their share buyback. So exactly, Moeed, as you were talking about, they have an intention of share buybacks. They were doing that in previous years as well. So there's 381 million of share buy. Sorry, I've got the wrong one. The share buyback, that's this one here. So 381 million, another 368 million. Nothing. You'll notice during 2020, that's probably due to the pandemic. Everyone's a little bit nervous. It's like, you know what? Let's not do anything. Let's just hold fire, see how the things pan out, and then once we're kind of through the pandemic, it's like we can start again, and let's carry on doing those share buybacks. So no dividends, but the share buybacks, obviously there's less shares in circulation, which means that there's going to, the value per share should be rising. And then we've got the cash flow. So, once again, as we'd expect with a company with lots of these deferred revenues, lots of very, very strong cash. So lots of cash coming into the business, very beneficial. You'll notice that there's some negative changes in the working capital. That's kind of expected. What this is basically saying, this accounts receivable, it's a negative number, says the amount that they're owed by their customers has gone up, and therefore they have less cash, but they're a growing business, so you'd expect that amount to go up. Same with inventory. They're a growing business, so you'd expect them to have more inventory, and that more inventory results into less cash. That's a particular point for rapidly growing companies like this, that often you find that rapidly growing companies, they run out of cash. These guys are rapidly growing, but they are managing their business. They're not running out of cash. They're maintaining liquidity. They've got enough money in the bank to survive, and so they can fund that expansion. So if you are a small company and you're rapidly growing and you're scratching your head and going, why do I never have enough money at the end of the month? Then that is often why it all gets tied up in working capital. Give me a shout and I will take you through the details of your business. Little bit of investment going on. Here's our investment, just to again to be aware of that this purchase of marketable securities, that's not really investment, that's just parking spare cash in a deposit account. So I'm really interested in this number here, 400 million of investment, and we could compare that 400 million of investment, we might compare that to the depreciation of 108, which effectively says if your existing assets are depreciating at 108 and you're buying 400, then effectively you are clearly a growing business. So there's our investment, and then finally the effect of financing. So there's the stock repurchases, nothing last year. You can see it from the previous year as well. Bit of tax being paid. Interesting, there's a kind of question mark, why they'd be issuing common stock in order just to repay common stock. I have no idea what's going on about that. It's a fairly consistent number each year, but what's going on there, I have absolutely no idea. Anyway, the sum total is that they've got a lot of cash sitting in the bank. Look at that. They've got $1.1 billion parked in the bank account in the at the end of the year, plus a whole lot of marketable securities. So lots and lots of cash. So sum total, these guys, it's strong. They are profitable. They've got a strong balance sheet. They are generating, they're generating cash. Life is looking pretty good for these guys. There's no debt sitting on the balance sheet. They're liquid. Return on capital isn't really a kind of a big driver, I don't think, for these guys, but 27% if you're interested. They, so strong liquidity, even on an acid test where we eliminate the inventory, is looking good. Working capital requirement I've mentioned, and good strong cash flows. So let's have a look at what the market thinks of these guys. So here is the latest share price from just earlier today. And quite interesting, there's no PE ratio. I don't know why there's no PE ratio from Google, but anyway, I can tell you that they're trading on about 20 times earnings. 20 times earnings, if you flip it, is a yield of about 5%. Now, if this company really is growing at 60% a year, and they can maintain that, and that's a very big if, by the way, then 20 times earnings looks pretty reasonable to me. So they've got a market cap of 5 billion. The earnings is about 770 million. 20 times earnings. There's no dividend yield, but if you take the share buyback yield, it's about 2.5%. Their balance sheet, if you remember, was 3.6 billion. That's the equity element of their balance sheet. 3.6 billion compared with 15 billion market cap means that most of it is goodwill. It's about 11.4 billion of goodwill, or inherent goodwill as we call it there. And that's really it. So it's it's not massively expensive. It's not cheap, by the way. It's not cheap, but it isn't massively expensive. So quite interesting looking at down here. Now, anything you buy, remember, you can lose 100%. Everything can go to zero. I don't think these guys are going to go to zero. I just, they've got a really good, solid set of financials. Maybe kind of this area here, it's just overvalued. It's valued too highly. Interesting enough, you can kind of, this is the pandemic, and there's a kind of a bounce back, and maybe it just got ahead of itself, and it's just been correcting downwards. So if we kind of draw, there's something called a head and shoulders, which chartists like. So you kind of draw a line like this and you say, well, look, it's gone all the way up, and actually a head and shoulders is kind of, you go up, and then you go to the head, okay, and then you come back to the shoulders. And maybe I'm slightly making this up, but there's a kind of a sense that it's taken it all back out again. So it's back down to kind of right down the bottom, and maybe this is a possible buying opportunity now for a company which is going to start to kind of deliver on its promises. So there is the analysis from me, Moeed. I hope you found that useful and interesting. Am I an investor? No. Would I be? I don't see why not. I mean, I try not to kind of, invest in everything that we analyze, but it looks to me like these guys, and I don't know their business. I don't know their business model. I don't know their expansion plans. I don't know their economic moat. I don't know the strength of their brand in their sector. I don't know the competition, how competitive it is, whether they're going to lose, because they're making a 74% margin. That's massive. If you're a customer of these guys and you're buying these 3D bits and pieces and all the rest of it, you're basically, for every $100 you pay, it only costs them $25 to buy the thing that you're buying. So that's a pretty big margin. And I'd be surprised if there weren't other companies looking at that margin and thinking, we'll have a bit of that. And therefore you end up with a lot of pricing pressure, and the margins start to come down. So that's kind of just a little bit of a caveat on that. And if you are a customer, I'd get your negotiation boots on with these guys, and maybe see if you can get a bit of a discount, because they can certainly afford it.
Yeah, and there you have it. And all those areas that Ted talked about, that's, for your own analysis and your own research. We're interested in the financials to help you understand and read those financial statements. And as you saw, all those questions start with understanding the financial statements. So that was, hopefully that was very useful for you. I did promise to share with you how you can actually make your own recommendations. Now, if you're thinking about investing in a company, or if you think about selling services to this company, or even if you're going for an interview and you want to know the financials in a bit more detail, all you have to do is leave a note in the comment section of any one of our videos. Of course, mention the name of the company and give us the reason why you're interested in them. Because if you give us that reason, then we can actually mention those reasons and start to make it personal to you as well. So do leave a note in the comment section. Obviously, don't forget to like, share, and subscribe, particularly if you have people in your community that are interested in these companies. Don't forget to share these videos with them. So until the next video, thank you, Ted. Thank you, everyone. We'll see you on the next one.
Good to see you, Moby. Catch you later.